What's up everyone and welcome back to the channel. My name is Sean and this is We Are Investing. On today's video, we are going to dive into NVIDIA stock. We're going to take a look at this company, this stock, to see if you should be investing in it right now. And if you do want to invest in NVIDIA, a way to go about it that's less risky and will likely provide great returns in the long run. So let's dive right into it. First and foremost, NVIDIA is a very popular stock right now and trades at extremely high valuations. Currently at these prices, the stock is pricing in tremendous growth in the future that has to be realized to justify the current share price. But there is one thing currently that is driving the share price higher regardless of valuation, and that's momentum and what's also known as FOMO, fear of missing out. There's a ton of money piling into NVIDIA stock right now, even at these current valuations, which continues to push the stock price higher. Even with technicals showing that it's extremely overbought on the daily, weekly, and even monthly charts. But this does not stop people from piling into the stock and continues to drive the share price higher. Ultimately, we are going to see a pullback. That pullback can be at these prices right now, and it can be a significant pullback, 25-30%, or it can be 20, 30, 40, 50% higher from the current prices until ultimately we see that pullback. So I get it. People want to invest in the stock because the future is bright and there is a lot to like about this corporation. But how can you do so without exposing yourself to tremendous amount of risk? First, I want to look at the charts just to show you the crazy price action that NVIDIA has experienced over the last year. We're on Thinkorswim right now, and this chart on the left is the daily chart, and it doesn't do it justice. But as a trader, that's probably the first chart you're going to look at, and here below is the RSI, and you can see that we're still overbought. Now, NVIDIA got overbought on the daily chart right here, right? This big move up. And just because it was overbought doesn't mean the stock needs to sell off. And that kind of goes to show that the momentum can continue much higher. That overbought signal happened at $386, and the stock is currently trading at $480 a share. Ultimately, it is going to pull back, but it can continue much higher until it does so. If we look at the weekly chart, this does a little bit more justice because we can see the share price at the prior high and how we have skyrocketed past it and moved much higher in a very short time. NVIDIA stock hit a low of around $107 back in October of 2022. I'm filming this right now on July 14th, and we're currently trading at $480 a share. So in less than a year, we rocket past the prior high of $350 and are trading 38% higher than those prior highs. If we look at the RSI on the weekly chart, we can see that we are extremely overbought. We're at 88. But like I said, that just shows that momentum's very strong to the upside, and we could possibly be higher until we actually see a pullback. But I feel very confident a pullback is coming at some point. Now, if we take a look at the monthly chart, this is going to show us even more data and how we can see that this stock has been a tremendous performer over the last decade. The prior peak happened in 2018 at around $65 a share. And then we had a huge boom back in COVID where we saw a prior high in December of 2021. And right now the stock is currently trading at all-time highs. Now again, on the monthly chart, we are overbought. We are above 70 on the RSI. But if we look at times that we approached overbought before on the RSI, let's just go back to this example here during COVID where we got to $132 a share. You can see that we were trading at 75 on the RSI, and we ultimately got to $345 a share until we saw that massive pullback. So the stock more than doubled while being overbought on the RSI. That's the technicals. That's the kind of risk we have with NVIDIA. We can see one of those epic pullbacks coming up. We just don't know if that's really going to happen, and if it does, at what price will it happen? Now, in terms of valuation, you can see that the current price to earnings ratio for NVIDIA is 236, which is extremely high. This is not a cheap stock to buy right now. But you might be saying, oh, I understand that, but I want to hold this for 20, 30 years. And I think in 20, 30 years, the stock price is going to be much higher. And it could be. There's a possibility that that could happen. But I think investing just in NVIDIA at these current prices provides a ton of risk. And even if you are right, how much money will you ultimately make, and will you beat the overall market? Nobody knows. There's a possibility that you can. I'm just not personally comfortable with that level of risk, especially at these current valuations, and especially with how much the stock has gone up over the last year. Now, one way you can invest in NVIDIA right now, and a safe way to invest, is to look for funds that are tried and true, that have exposure, a higher amount of allocation in NVIDIA. This kind of gives you the best of both worlds. It's going to provide you diversification, while it's also going to provide you a nice stake in NVIDIA, because these ETFs that I'm going to show you all have a significant amount of money in NVIDIA stock. Now, there are 5 ETFs on my chart right now that we're going to go over. Now, the first stock is FBCG. That's the first ETF, and this is the Fidelity Blue Chip Growth ETF. Now, there are 2 main things that I want to focus on. The first one is expense ratio. This fund has an expense ratio of 0.6%. The second thing that I want to focus on is the holdings and how much weight is in NVIDIA. This ETF has 10% of its holdings in NVIDIA, which is a significant amount. The next ETF is QQQ, which is the NASDAQ, or which is the Invesco QQQ Trust. Now, the expense ratio on this is much lower at 0.2%, but the weighting is also lower at 7.34%. The next ETF is the SPYG, which is the SPDR Portfolio S&P 500 Growth ETF. There's a theme here. All of these ETFs are going to be focused on growth. Because of that strategy, they're going to have higher weightings in NVIDIA stock. Now, this ETF has an expense ratio that is extremely low at 0.04%, which is good. The lower the expense ratio, the higher your returns are, because the less you're going to be paying in fees. Now, this ETF has a weighting of 5.6% in NVIDIA. Now, one thing to keep in mind is, depending on how NVIDIA performs, the weighting of NVIDIA on all these ETFs will change. And there could be a point where NVIDIA outperforms Apple and becomes the highest weighting stock in the ETF, which in this case right now, Apple's at 13.87%. Now, I want to point that out because I think it's important, because it's going to let your winners grow with you. So if NVIDIA actually does perform really well, you're going to increase your weighting in NVIDIA, which is what you want to do. But if NVIDIA gets that huge pullback and doesn't actually live up to the hype and becomes the Intel of the dot-com bubble, well, it's not going to hurt you so much because you're not all in on NVIDIA. And the ETF is going to adjust, and you're going to invest in companies that are really performing well, probably from artificial intelligence. The next ETF is IVW, which is the iShares S&P 500 Growth ETF. The expense ratio is 0.18%, and the NVIDIA weighting is 5.59%. And then the last ETF, which is one that I personally invest in, is the Vanguard Growth ETF, ticker symbol VUG. This has a very low expense ratio of 0.04% and has an allocation in NVIDIA of 4.52%. Apple being the highest at 13.61%. So now let's test these ETFs and see how they stack up against each other. Now, here are our parameters. We're going to go back to 1985 if possible. If not, we're going to go back to as far as we can with the data that we have. We're going to have an initial contribution of $10,000, and then we are going to continue to contribute $500 monthly to see what our total balance is. And this is how people would invest. You would invest money every single month, whether it's through a 401k and that money's being deducted from your paycheck, or you're investing in a Roth IRA for yourself, or you're just investing every single month with the savings that you have put aside to actually invest in the market. We are going to reinvest our dividends. If these ETFs have dividends, which a lot of them do, we're going to reinvest those dividends into the fund to increase our total allocation and help with our compounding growth. The first three ETFs we're looking at is FBCG, QQQ, and SPYG. Now let's look at the results. Now, unfortunately, because one of the ETFs is new, FBCG, we can only go back to January 2021. So this data isn't very reliable in my personal opinion because this is a 2-year investment. So unfortunately, FBCG isn't going to give us the data we want to see to determine if it is one of the better ETFs. But we're going to work with what we have right now. So if we look at FBCG, our final balance is $28,429, QQQ over $30,000, and SPYG at $28,635. The max drawdown and the worst year are the highest for FBCG, the worst year at negative 39%, and the max drawdown at negative 39.9%. The standard deviation for FBCG is the highest at 25.57%. So when I look at this data here, what does it show me? While it's very limited, it shows me that FBCG isn't the top performer and it has the highest amount of volatility, which isn't something that I want to see. If you have if you have the highest amount of volatility, I expect the highest final balance to counterweight that. If you don't have the highest final balance and you do have the highest volatility, well, then it's not worth it in my personal opinion, and you're better investing in QQQ or SPYG. Now, if I had to pick one, I would probably pick SPYG because it has a lower standard deviation, meaning less volatility, which is displayed in lower worst year, 29% compared to negative 32%, and a lower max drawdown of negative 30 compared to negative 32%. And the difference in final balance of around 2,000 might be eaten up by the expense ratio difference, with QQQ at 0.2 and SPYG at 0.04%. If we compare the two, a 0.2% with some estimated returns, a 10%, $10,000 initial investment, $6,000 every year, a 0.2% expense ratio is going to cost you $45,000, but a 0.04% is only going to cost you $9,000. So you're saving yourself around $36,000 in fees with that lower fund. So I would be more inclined to invest in SPYG out of these three, based on the data that we have. Now I'm going to swap out FBCG with IVW just to see if we can get some more data. Now we're going back to 2001, which is a fair amount of data, so I feel much better about the information we're going to see here. Now this information provides a different story. This information shows that QQQ is the much better performer at a CAGR of 23.66%, a final balance of 1.18 million, compared to IVW at $748,000 and SPYG at $740,000. So actually in this scenario, I would be more inclined to invest in QQQ if I want those really powerful returns and I'm okay with the risk, and I would pick IVW over SPYG. So let's keep IVW, QQQ, and let's include VUG into the mix as well. Now let's take a look at the results. We have IVW at final balance of $534,000, QQQ at $825,000, and VUG at $570,000. The CAGR for IVW is 24%, QQQ at 26.94%, and VUG at 24.42%. The standard deviation is the lowest for IVW and is the highest for QQQ. The best year is obviously much higher for QQQ at 54.68%, but it also has the lowest worst year, or the highest worst year, a negative 41.73%, and the highest max drawdown at 49.74%. But the difference between max drawdown from IVW to QQQ or VUG to QQQ is only a couple percentage points, but the return is much better. a couple $100,000 more. So in this scenario, with this data, I think if you want to invest in NVIDIA and you plan to invest in it for the long term, I think some allocation to QQQ might be worthwhile. If you want to be more conservative and you don't want to take on as much risk, then a stock ETF like VUG or VOO is also a good bet. Investing is based on personal preference and risk tolerance. No one investment strategy is going to fit everybody, and this is not financial advice, but the numbers I am showing you here can help give you an idea of what your potential returns could be. It's also showing you a way to get into NVIDIA that has less risk, in my personal opinion, while it can also provide great returns. Now, speaking on that, let's say that NVIDIA, for some reason, actually doesn't perform that well and performs very similar to Intel. Now, Intel during the dot-com bubble was one of the best stocks there, and everybody was extremely bullish on it because they were extremely bullish on the internet and computers. The invention of the internet and computers was huge for the economy, had tremendous growth, but that growth doesn't always translate into higher share prices. And if we were to compare an investment in VUG to Intel back to 2005, this would be our results. VUG would have a final balance of $570,000, while Intel would have a final balance of $246,000. The standard deviation is much higher for Intel. You have much higher volatility and far less returns. This would severely underperform an investment in VUG or in the overall market. And that's the risk you have with investing in one stock like NVIDIA, or it could be one of the best performers. NVIDIA for Apple, which has been one of the best performers, and change this here and run the results. This is the potential reward with picking the best performing stock in the stock market. But there's only one of those stocks, so the chances of you getting this right are very low. But if you do get it right, you would have huge performance. You're looking at a final balance of $5.2 million compared to $570,000, a CAGR of 40%. A worse year that is higher, a max drawdown that is higher, but this final balance makes it worth it. But we're talking about probabilities here, and picking the one stock that is the top performer is extremely difficult to do, and nobody knows what stock that's going to be. We can have our guess, we can make our predictions, we can analyze the stocks, and we could project future returns, but there's no guarantee that that's actually going to happen. Now, if you want to see how I personally am invested in the market, you can check out this video, and it's going to show you the 3 funds that I personally invest in for my Roth IRA. Let me know what you think about NVIDIA for the long term or for a potential swing trade in the comment section down below. And outside of that, I thank you so much for your time. This is We Are Investing, and I'm out. See you on the next one.